Overall, the stock market is quite expensive right now. So for dividend investors, value investors like myself, it's sometimes difficult to find stock picks that are on sale. However, there are 3 stocks that are ridiculous values within the broader context of the overall stock market right now. Within the context of our stock market being towards record highs, there are 3 stocks, 3 value stocks, ridiculous values that I want to share with you today. So let's get started with today's dividend investing video. All right, everyone, so I'm going to jump right into it. The first stock pick that I want to share with you today is one that I have been purchasing lately. This is AbbVie, ticker symbol ABBV. I've already discussed this one at length recently. I'll link in the description below so you can check that out. But the reason I'm bringing up AbbVie again is, one, I bought a few more shares on Friday this past week, but also there's some insights that I want to share around purchasing AbbVie, because there are certain investors that are asking me, hey Ian, I've heard that it's better to purchase AbbVie through Allergan. So we're going to talk about that today. Anyways, AbbVie, I first started buying at $69.02. I bought some more shares at $69.72. I'm going to keep buying in this range until it reaches a full size. Why? The starting yield is a 6.14%. The compound annual growth rate of the dividend has been 21% for the last 5 years. And in my opinion, most importantly with this one, the price earnings ratio on a forward basis for 2019 for this stock is a 7.94. Let me repeat that. If you take the price of this stock, which is $69 and change, you divide by the analyst consensus estimates for 2019, the PE ratio forward for 2019 on this stock is a 7.94. That is just bargain basement. This thing is priced as if it's going to go out of business. At these types of PE ratios, I can't ignore it. I just have to buy this thing. And I think the Allergan deal is going to be really good. They're going to rack up a lot of debt, but I think the diversification is good. And I think interest rates are going to stay low for some time. So companies that are taking on debt, quite frankly, are probably going to be rewarded. It creates longer term risk, but my hypothesis is that these guys will pay down the debt. Now, the reason I'm bringing up AbbVie again, though, is I get this question, and I got it again from one of my old-time subscribers. There's this guy, Justin Law. He just did an article on Seeking Alpha, and I'm actually going to link to his article in the description below. I thought it was a really good article, and one of my subscribers said, Ian, what do you think about Justin's article? And the hypothesis of this article is, hey, if you want to buy AbbVie, you shouldn't be buying AbbVie the way I have. What you ought to be doing is buying Allergan, because the economics just so work out that there's an arbitrage opportunity there buying Allergan. I want to go through that with you a few minutes here. By the way, I am exhausted. It's really late at night, and so I'm doing my best to get through this video. I got to get it out for all of the true thugs out there, thug life investing. So thank you for bearing with me. This may not be the most polished presentation I've done, but there's sure a lot of heart behind it, and I am hustling for the thug life community out there. I love you guys. So anyways, Seeking Alpha, I'm just going through Justin's analysis here. Again, I'm going to link to it in the description below. But then I'm going to talk about Justin's analysis and what I think about it, and why I'm not buying Allergan. And I don't think it makes sense, at least for someone like myself, to buy Allergan. There are certain people, certain types of investors where it may make sense. We're going to talk about that. So anyways, Allergan's trading at $165 per share. The deal, though, the deal with AbbVie is each share of Allergan, it's going to get you $120 in cash, and it's going to get you 0.866 shares of AbbVie. So if you just do the math, hey, when this deal closes, assuming it's going to close, I'm going to get $120, and I'm going to get 0.866 multiplied by the current share price of AbbVie. a current share price actually in that $69 range, but when Justin did his analysis, it was at 70. So I'm using Justin's numbers here. If you add $120 cash and then 0.866 times the $70 share price for AbbVie, you basically get 181. And so what the deal that has been offered out to buy Allergan, AbbVie is going to buy Allergan. AbbVie, in essence, is going to pay $180, $181 per share. But wait a minute, Allergan right now is trading for $165. So there's an arbitrage opportunity. And so assuming AbbVie doesn't tank too much more, I hope it does because I'll buy more, but assuming it's somewhat stable in this range, what it means is I can buy Allergan today at $165, but it's really worth $181. And so there's this 9% upside that is somewhat not combined with too much risk in the sense that it's just pure arbitrage, or just pure arbitrage upside. So that's a good thing. This is a good thing. Now, another way of looking at this, though, is take the $165, which it's currently trading at. That's where Allergan is trading. And let's subtract. Let's subtract out the cash component of the deal, which is $120 and change. Basically, what's left is $45. And so what this means is $45 right now buys you 0.866 shares of AbbVie. Well, if I take the $45, I divide by 0.866, what in essence it implies is that, hey, where Allergan is trading now, the AbbVie component of the deal structure, it's being valued at about $52 per share. But we know AbbVie is trading up at 69, and so there's this 25% discount on the AbbVie component of the deal. Anyways, needless to say, what these numbers spell out, it's plain as day. Everyone can see this. You buy Allergan, it's a cheaper way to get into the deal. It's cheaper because there's this risk, lower risk kind of, I guess anything carries risk, but what I'm saying is it's an arbitrage opportunity. And so in general, arbitrage carries a lower amount of risk because it's pure mathematics. If this deal works out, you get that arbitrage, so you get this upside. And the interesting component about this is just that the AbbVie part of this Allergan deal, the AbbVie component of the deal structure, it's just valuing the AbbVie shares really low. And so what Justin is saying is, hey, you want to own AbbVie, why buy AbbVie at $70 when you can buy it through Allergan at basically valuation of $52? That's what he's saying. And so you want to own AbbVie, go through Allergan, buy a ton of Allergan. It's a cost-effective way to get into AbbVie, even cheaper than buying AbbVie directly. So what could go wrong here? Here's why I'm not doing this. First and foremost, the deal might not work out. If the deal does not work out, basically, I don't want to be stuck with Allergan. It's just not a company I'm interested in. It pays a lower dividend. Its portfolio of products is not, in my opinion, as desirable as AbbVie's. AbbVie is the company I ultimately want to own. And if the deal doesn't go through, I'm going to hold on to my AbbVie, although I hope the deal goes through because I really want the combined company. Now, Justin says, well, you can buy puts and you can hedge against this. That's not for me. I am a buy and hold forever dividend investor. I like to buy stocks for the cash flow. I use the cash flow to pay bills. I'm already starting to do that. I'll link to in the description below to some information, to a video on how I just started doing this. Actually, I started paying some of my bills with dividends. And so doing puts, hedging my bets, that's nice and all, but it's not for me. Anyways, that's point one. What if the deal doesn't go through? Here, though, is really why this doesn't make sense for me. At a high level, what's happening here is I can buy Allergan at $165 and change per share. Fine. What does that $165 get me? It's getting me $120 in cash, and then it's getting me $45 worth of AbbVie for that $165. In other words, of this $165, how much am I going to get back in cash? How much am I getting? How much is actually going towards buying AbbVie? 27% is going towards buying AbbVie, 73% towards cash back. In other words, what's happening here is the percentage of the deal structure that is allocated to AbbVie, it's small. It's only 27%. The other 73% is cash. And so this idea of buying AbbVie through Allergan, it will work for someone who's operating at a very big scale. If you're an investor who's operating at a huge scale, you've got a lot of cash sitting around, and you want to go this route may make sense for you. But for me, I don't always have a lot of cash sitting around. I have emergency funds, I have cash, stockpile, but in general, you guys know it if you've been following my channel for a while, I like to be fully invested. And so for me, I need my money to work for me now. I need to get as much money as possible into AbbVie now. And the problem with going through Allergan is only 27% of the money that's actually being deployed into Allergan is going to get into AbbVie. The rest of it I'm getting as cash back. I mean, in 2020 when the deal goes through, I'm getting the rest of that as cash back. And so for me, there's a few problems with this. One, what if between now and when the deal closes, AbbVie stock goes way up? So that's kind of one challenge, because when I get all my cash back, what if I want to buy more AbbVie with it? Well, what if the stock has gone up? Another issue with this is in 2020, there's a few deals I'm outlining today. AbbVie is just the first one, by the way. I'm going to discuss two other stock picks today that I think are ridiculous deals right now, at least in the context of the stock market we're in. But what if in 2020 there's no more deals? What if the deals are gone? Right now, thankfully, the market is at all-time highs, but there's these pockets. There's these pockets of opportunity. What if these pockets are gone? And so it's all nice, that I'm paying $165, I'm going to get 120 of that back in cash. But when I get my cash back, hypothetically, if I were to buy Allergan, what if there's nowhere I want to put my cash when I get it back? So the problem with this deal structure, if you go through Allergan, is it's real low leverage in the sense that the AbbVie you're getting for the money, it's a very small component of AbbVie. And the bigger component is all this cash. And again, fine, I put all this cash in, I get all this cash back. What if there are no deals at that point? Now, who would this, and point 3 is just taxable consequences on getting this cash back. That's something that needs to be thought through as well. But who would this work for? This method of getting into AbbVie through Allergan, it may work for someone who is extremely heavy on cash right now. Let's say there's an investor out there, they're like 50% cash, 50% stocks, and they kind of want to keep it that way. They want to have a big cash position. This could work for someone like that. They go, fine, go really heavy into Allergan, knowing that they're going to get a lot of cash back, and it gets them their allocation to AbbVie as a discount. But for someone like myself, again, I'm not real heavy on cash. I'm not a big fan of cash. I'm a big fan of getting my money to work for me immediately. I want to get my money into stocks like AbbVie that starts throwing off cash flow that I can use to pay the bills now. And I'm already starting to do this. I'm going to be doing this more and more in the coming years. So I need cash flow now. And so I don't have a lot of cash sitting around because I get my cash to work for me. And so for me, the challenge going this route is, okay, I want to get into this thing. It's just such low leverage. The amount of AbbVie that I end up getting at the end of the day for all of this, it's too small. Because again, most of the money going to Allergan, it's coming back as cash. So complex topic here, a lot to think through. Again, in a nutshell, I think Justin's strategy does have a lot of merit. I think it especially has merit for a very large investor who has a big cash allocation and doesn't mind having a cash allocation going forward. But for someone like me who's kind of smaller on cash, who wants the money working for them now, just going through Allergan and then getting all that cash back, it's too low leverage. It's just too low leverage. I'm not getting enough raw AbbVie shares for what I'm doing. I'd rather pay a little more for AbbVie, knowing that I'm getting the shares, I'm getting the money to work for me, and I'm getting that exposure to AbbVie without that cash allocation of the deal. I just don't want that cash component. So, fabulous question. I love this question. It gets technical. I hope you guys are able to follow along. It's probably not the best thing for me to be going through this hour at night when I'm really tired. So I hope I did an okay job explaining this to everyone out there. But yeah, thank you. Thank you for this question. It's a good one. But going back just to the topic of the video today, this is why I'm buying AbbVie and not Allergan. And the reason I like AbbVie, and I think it's a ridiculous value right now in this stock market, really comes down to this PE ratio of 7.94. Does not get much better than that. So I want to move on. I want to talk about another pharmaceutical stock. On Friday again, J&J, my #1 favorite stock of all time. It's popping up in the news again. It has a way of doing that. And unfortunately, look, my heart goes out to anyone that may be affected by the allegations that are coming against J&J. I don't know if they're true, they're false. We'll let the court of law decide all of that. But what's happening is this whole talc powder issue. It's coming back. It's coming back into the forefront again, and it caused J&J stock to tank, and it caused it to go down about 4 or 5% or so on Friday. And so I'm getting questions from subscribers. Hey, Ian, your #1 favorite stock of all time. Are you buying more J&J now? What do you think about J&J? And so I want to share with you today what I think about J&J right now. All right, so I have my computer now, and I jotted down some notes there, which I'm going to go through, but also I have them on the whiteboard here. Not quite as much, though, so that's why I'm going to the computer, because I got all my notes here. So first and foremost, you got to know my history with J&J. I first started buying this thing in 2011 for $58, and I went pretty big. My most recent purchases that were really large, big purchases were in 2016, and they were at $112 and $116. So right now, J&J is trading at $134. Mind you, I did a video, I will link in the description below, back in December when this whole talc powder thing came into the forefront. The stock tanked. It was down like 10% in a single day. And I looked back, what was J&J trading at around that time? It was the same thing. It was kind of in those mid 130 range. And so the value that investors are getting right now in Johnson & Johnson, very similar to the value they would have gotten if they bought back in December of 2018. And so that just gives a kind of gut check. Where is this thing trading? And what it tells me at a high level is, look, Ian, it's still a lot higher than historically where you have bought it. That being said, it's my #1 favorite stock of all time. I love this company, and it's probably not a bad time to start averaging in again. And that's what I want to talk about next, actually, because I do think in the context of this overall stock market, it's not a value like AbbVie, but I still think it's a reasonably ridiculous value for such an amazing company. So one of the best companies, my #1 favorite company in the world. And so let's talk about this. So J&J pays 95 cents dividend per quarter, or $3.80 per year. If you take that, you divide by the 134, starting dividend yield is a 2.8. 2.8, it's an okay starting yield for J&J. I'd say that's pretty fair. The compound annual growth rate, looking at the last 5 years for J&J's dividend, it's nothing like AbbVie, but it's a respectable 6%. I think that they have room to go much bigger than that, because the payout ratio is quite low. It's 44%. And so 44% payout ratio definitely gives J&J some room to raise the dividend. By the way, AbbVie's payout ratio is also really low. I'm going to pull that really quick because I didn't put it here. That's 49%. And so AbbVie as well still has a lot of room to increase their dividend as well. Okay, so by the way, J&J is 7.2% of my portfolio, so really big allocation. So what does it come down to J&J with me when I'm looking at value? Again, I kind of looking at the forward PE ratio. If I take consensus estimates for 2018, and you're wondering, Ian, where do you pull these consensus estimates? What I do is I go to Yahoo Finance, I type in the ticker, and I look at the tab called Analysis, I think it's what it's called. And on Analysis, it shows all of the estimates from all of the different stock analysts. And basically what I pulled is the average, the consensus estimate. I take the share price, I divide by that, I get a forward 2019 PE. Basically, J&J is trading at 15.6. This is why it's a ridiculous value right now. I just shared a video. I will link in the description below. I shared my overall dividend stock portfolio, all of the positions. And what I did is I have a column in there, a brand new column, and that column shows the PE ratio forward 2019 for all of my positions. And what's so interesting is the average PE for my overall portfolio forward at this time is a 20. It's actually over 20. It's like a 20 and change. I thought this was really high. Some of my subscribers are like, hey, Ian, it doesn't seem that high because interest rates are really low. I don't want to debate that. Whether interest rates are low or not, 20, a PE of 20 is high. That is a high historical PE. That being said, the way I look at things is if my overall PE is 20, AbbVie is at a 7.94. Come on, that is a steal. Yeah, there is risk. I'm not going to sugarcoat it. There's big risk with this company, but it's priced as if it's going to go out of business. Let's say earnings get cut in half. That PE of almost 8, it'll be 16, which I think is a fair value. And so it's basically being priced, in my opinion, AbbVie, as if the earnings are going to get cut in half. I don't think they will, but I think there's very little risk left given the share price of AbbVie here, but we shall see. J&J, the way I look at it, huge company. I think their market cap is somewhere around $300 billion. Very well diversified across pharmaceuticals, across medical devices, and across just healthcare, home care, that, selling consumer household products like Band-Aids, for example. And so the thing about J&J is it's so diversified. It's like owning a mutual fund in the healthcare industry. They are so well represented. They've made so many acquisitions. They're so big. And really well managed company, just fabulous financials. The fact that they're trading right now at a 15.6 PE, whereas my forward 2019, whereas my overall portfolio is at a 20, that's why I call this a ridiculous value right now. It's not a ridiculous value, I'd say, on a starting yield. It's okay. But it really, for me, comes down to that PE ratio as compared to my overall portfolio. And typically for a company like J&J, I would expect the PE ratio to be higher than my average. Why? Because of its quality. AbbVie, I would expect it to be lower. If my overall portfolio is at a 20, maybe AbbVie's at like a 15 or something, or maybe 14. It's at a 7.94, so it's way too low, but it should be lower. J&J should not be lower. It should be higher. It is such a quality company. We've talked about this before. I'll link in the description below. And so I think that's a great value right now. Personally, have I bought any more J&J yet? Not yet. I haven't done that, but I will most likely be averaging into some more J&J sometime in the coming months if the share price is in this range. Personally, I would prefer to buy if it were in the 120s or even the 1-teens, because like I said, the last time I deployed a lot of money, big purchases into J&J was back in 2016 when it was trading at $112 a share, and some of my tranches were at $116 per share. So that's stock pick number 2 today. Stock pick number 3 is one I've received some questions on recently. By the way, I'm celebrating 30,000 subscribers here. I love you guys. Thank you for the support. 2 of these stocks I'm talking about today, actually all 3 of these are really response to subscriber questions. So I wanted to go through 30 subscriber questions to celebrate the milestone. Today, this is going to be 3 of them, because the question 1 was this Justin Law kind of buying Allergan idea. Did that question. Question 2 was, Ian, what do you think about J&J? So addressing that. Question 3 is Caterpillar, ticker symbol CAT. I own the stock. I don't talk about it a lot. People are asking me, Ian, is it a value? I do think it's a value here. Similar to a 3M, the industrials right now are on sale. There are some values in industrials, and I look at Caterpillar that way. By the way, I'm just going to get this out of the way. Yes, I think 3M is still a value. I'm still buying 3M. I will buy more. Cedar Fair, ticker symbol FUN. That one I think is a value too, and I'm still buying more of that. The reason I'm not talking about those 2 today is I already talk about them at length, and so I wanted to go through 3 picks today that I don't talk about quite as much. They're kind of newer to the conversation, at least the recent conversation. So that's why 3M, Cedar Fair aren't on the list today, but they're 2 values as well. I think they're both ridiculous values. Though actually those 5 stocks that make up the ones that I'm really keeping my eye on right now. Anyways, Caterpillar. So I got my notes again. Again, I apologize, everyone. This It's probably not a very polished video, but I am doing my best. I am real tired, but I'm doing my best to deliver excellent content out there on YouTube. I love you guys. So Thug Life, thank you for hanging in there. All right, so the Caterpillar is trading at 138 per share. Consensus estimate for 2019 forward is a 12.3. That puts the PE ratio at 11.25. Again, the way I do this is I take the price per share, I divide by the consensus estimate, I get the forward PE. The PE on this thing at 11, come on, that is really, really low. And so that is, in my opinion, a good value. But what makes it more of a value is this. Dividend per quarter is $1.03. If I multiply that by 4, I get the dividend per year. If I divide that by the consensus estimate, I get a payout ratio on these guys of 33%. The opportunity for Caterpillar to raise their dividend is phenomenal. With a payout ratio of only 33%, they got a lot of room to increase it. Now, a company like this is very cyclical and their earnings can go up and down, so I never think it's going to have a huge payout ratio, but at 33%, there's a lot of room to grow the dividend. And they did just that. The most recent increase was 20%. They raised the dividend 20% from the prior rate. And so the dividend right now, starting dividend yield is a 3%, and the compound annual growth rate for the last 5 years is 8%. And that 8% includes the big bump that happened last time, which was 20%. So something else to mention, I started buying this thing in 2013 at $86. Right now it's at $138. So just some context, my relationship with Caterpillar and what I love about these guys is 59% of their sales are international. By the way, I just did a whole analysis. I looked at every stock in my portfolio, and I'll link in the description below. If you download my stock portfolio, you will actually see the international versus US component of their revenue. I went through all the annual reports. I did all the data mining for the benefit of the community, for the benefit of myself, quite frankly, too, because I wanted to see all this data. But what was interesting is Caterpillar has great international exposure. Not so much with AbbVie. AbbVie is real focused on US. J&J, it's got a big US exposure too, but they're okay. They got some international. Caterpillar, real focused international, and so I like that. So the thing about Caterpillar that is so enticing for me right now is that PE ratio forward at 11, and the fact that the payout ratio is low, and the fact that the dividend yield, it's okay, it's 3%, but it's growing, and they're going to grow it quickly. Now, the risk factor that comes with Caterpillar, highly cyclical. They're basically making equipment that is used for industries like oil, used for industries like construction, and so they're dependent on the worldwide economy thriving. Unfortunately, there are signs right now that the economy is starting to slow down. This is one of the reasons 3M, quite frankly, has had poor earnings and why their stock is going down. And so 3M is a leading indicator. I think Caterpillar, being another industrial, cyclical type company, they could face some headwinds. And quite frankly, some of these analyst estimates, they may be wrong. The analysts may be overestimating where these guys come in, and when times get tough, times get real tough for Caterpillar. If you're newer to Caterpillar, you're newer to the stock market, look at some of the history. You'll see this. This stock can have some sharp downturns, and so I think it's a good value here within, again, the context of this stock market where everything is way up. My overall portfolio is at a PE of 20 on a forward basis. I think Caterpillar is a ridiculous value at a PE of 11, as with AbbVie at a 7.94, as with J&J at a 15.6. I think all three of these are pretty much ridiculous values in the context of the overall stock market. But again, this is a lofty stock market, late stage bull market. Our overall, the stock market's a reflection of the economy. Overall, this economy, it is kind of, in my opinion, running on fumes right now. It's kind of, the gas tank is empty. And so this economy, at some point, the worldwide economy, it's going to slow down. And when it does, are companies going to be buying and procuring new Caterpillar equipment? No, they're going to wait on those types of purchases. And so this company could face some hard times. That being said, like I was mentioning, the PE of 11, the starting yield, the dividend growth rate, the low payout ratio, all has it being a very compelling stock pick for me. I'll likely be buying some more Caterpillar in the coming months. It's a real small position for me. I'm already a bit over allocated to it. That's okay. I'll buy some more. In the context of adding more money to industrials overall, which is something I want to do, I'm happy to add a little bit more money to Caterpillar. So those are the 3 stock picks that I think are values right now. Put in the comments below, what do you think about these stocks? What do you think about 3M and Cedar Fair as well? Do you like those ones? These are the 5 that are top of mind for me. When I go to bed tonight, get some sleep, which I desperately need, this is what I dream about. These are the stocks that this thug is going to be dreaming about those dividends coming in. And so, which stocks do you dream about? Which ones do you think are good values right now in the context of a stock market that's really, really expensive? I'd love to hear in the comments section below. All right, everyone, before I leave today, in terms of full disclosure, I am long 3M, ticker symbol MMM, Cedar Fair, ticker symbol FUN, Apple, ticker symbol AAPL, AbbVie, ticker symbol ABBV, J&J, ticker symbol J&J, and Caterpillar, ticker symbol CAT. I own all those stocks in my personal dividend stock portfolio. In terms of a full disclosure, or a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. Everyone, took a lot for me to get this video out tonight, so if you could go the extra mile and share this one for me, comment, all of that would mean the world to me. Wishing you all of the best, and I'll see you in the next dividend investing video.